I welcome you in lecture 18 regarding legal compliance for incorporating startup, and I am in the module of finance and legal compliance, and now I am specifically talk regarding raising the fund from financial institution. And I believe I have used this particular word before in my different lectures, different point of time in my lectures. And before I go ahead how to raise the fund, let me explain to you what do I mean by the word financial institution. Now, financial institutions are generally those companies or those firms who basically lend the money or make an investment into the business, because they expect kind of a return of their investment, and whatever the investment they get, they basically distribute amongst their customer or the investors or depositors. So, in case of the financial institution, in here you will find I have basically named number of or types of banks. Like first one I have said is a scheduled bank. Scheduled bank is actually those banks which have been included in the schedule of banking regulation, because the bank are generally governed by Banking Regulation Act 1956, and these particular banking regulations are act basically administered by the Reserve Bank of India. So, they basically notify that which is a scheduled bank. Now, the scheduled bank can do the commercial lending, and therein there is a specified guideline is there, and they keep on improve this particular guideline or change this particular guideline in which sector this particular bank can make the lending. Now, a few minutes back I was talking with you the lending by the scheduled bank to the MSME. Now, you will find this particular divisions is almost available with all the bank, because government want to promote this particular MSME sectors, and at present also you will find there is a dedicated division also there in all the scheduled bank relating to the startups. So, either you fall within the MSMEs category as a startup, or you just want to promote it as a startup, you might access or raise the fund from this particular scheduled bank. Please remember, the scheduled bank make an investment in the different way. It might give a capital investment with a particular duration of time, or they might give you the loan. Most of the cases they generally give the working capital, that means they give the money in form of a loan itself. Now, again this particular relationship between the scheduled bank and the startup is governed by the bilateral agreement. Then you will find there is a commercial bank. Commercial bank are those banks who are basically incorporated for lending to the business only and particular segment of the business, where the government want to promote that particular segment, or where the government want to address this particular segment need, because there is a lot of demand from that particular segment, and they basically supply to the domestic need, and this particular commercial bank are created for that particular purpose. So, commercial bank is differ from the scheduled bank, because scheduled bank is generally do the transaction with the common people or take the deposit from the common people, but in case of the commercial bank they might not be allowed to take the deposit from the normal people or normal public. They might be only allowed to access some kind of a fund for raising their capital, which they can invest in the startup or they can invest in SMEs. Now, commercial bank again subject to certain regulation, and it has been specified that in which are the area they can go for making an investment. And in case of the commercial bank, you will find that they basically target a specific industry, as I have told already. Now, then you will find the Industrial and Development Bank, and Industrial and Development Bank was quite a old concept again in India, and we found that this is initiated around 1960s, because at that particular point of time they wanted to address the industrial growth or domestic industrial growth, and they thought there should be some specific financial institution who are dedicated for this particular purpose. Now, initially this Industrial and Development Bank used to finance by the commercial bank or the scheduled bank, or maybe the government or the RBI directly, but later on you find in some cases this particular industrial or development bank is allowed to raise the fund from the market itself, and then they can finance to the industry itself. But herein also again the mandate is only to finance to this particular particular industry sector for the purpose of the development. Now, this particular industrial bank also can raise the deposits or raise the money from the other corporates too, who wanted to make an investment of their reserves or the other proceeds in this particular development bank. Now, again you will find there is a cooperative bank is there. Cooperative bank is promoted by the different state government to create a local liquidity, that means to local availability of the fund. Now, cooperative banks generally raise the fund from the public at large or maybe target group of people, and then they give the make the investment in or they give the loan to different kind of businesses. So, again the cooperative bank large chunk or the majority of the money basically goes to the startup, or maybe it goes to the SMEs, to put it in other way around. And in all this cooperative bank you will find now there is a centralized system has been created, so that they can facilitate in the funding to the MSMEs or the startup. Now, again you will find there is a specialized bank is there, like SIDBIs, all other kind of bank who are basically finance to the small startups, and they are mandated with that, and they have also provided mandate that what kind of instrument they can make an investment in this particular startup. Now, again apart from these particular banks, you will find that there is a different other financial institutions. These are like insurance fund, and you will find one point of time in India insurance market was quite closed market, because in this particular market only the government companies has allowed to operate. Like there was a life insurance company as well as there is a general insurance company, and all those particular companies are the government companies, and they have also a lot of restriction relating to investment of their fund. Most of the time you will find this particular industrial this particular insurance fund used to make an investment in the government securities, but now you will find in present times they have also been allowed to make and diversify their investment into the other corporate portfolios, and they are even allowed to access to the equity market, either in primary as well as secondary market. So, in generally if your company is a public listed company, or if it is a public company, then you will find they will able to access this particular fund. And please do remember, they generally do not fund you in the beginning or when you are starting your startup. They only fund you when you make a progress, or you have a very good balance sheet, or you have a you are in the growth curve and your market is quite stable to make the earning, then only they make an investment. And this particular sector is now open to find out that where they can make an investment, but still you will find they can only make an investment a very less percentage of their entire fund into this particular equity or the corporate fund. Now, you will find the mutuals. Mutuals are those people again who basically raise their fund from the public by issuing the units, and mutual actually try to make the money by investing in different portfolios, and then getting the money out of those particular portfolio to distribute back to those people who have made an investment to these particular mutuals. Now, again there is a restriction relating the mutual fund where they can make an investment, but they are allowed to make an investment into the equity or corporate bonds or corporate debentures. Now, again if you wanted to access this particular fund, then you cannot do it in the beginning of your startup. Again, you need to be quite mature, and you should have a good balance sheet to access this particular fund. The similar case in case of the pension fund. Pension fund are generally put into a very secure fund, but to address the growth, many of the time they also allowed to make an investment in the corporate fund. So, if you are having a good balance sheet, if you have a good financial track record, if you have a good market credential, then in that case again you can go for the pension fund. Now, as I have talked with you in my last lecture relating to the public financial institution, there was some kind of institution which has been designated as a public financial institution under the previous Companies Act, that is CA 1956, Companies Act 1956, but this particular designation has taken away under the present Act of present Companies Act CA 2013. But nevertheless, it is important to know which are them called as public financial institution, like they are generally the Industrial Credit and Investment Corporation of India Limited, and this particular organization is incorporated under the Companies Act. Then you will find Industrial Finance Corporation of India. It is created under the Special Act. Then the Industrial Development Bank of India, Life Insurance Corporation, Unit Trust of India, then Infrastructure Development and Finance Company. So, all these particular financial institution has a specific mandate to make an investment into a particular sector. So, if you are looking for a working capital or short term capital, or if you are looking for a quick investment without going to the primary market, then in that case you generally access to these particular public financial institutions or other financial institution, because they are the people who are ready to make an investment if they found that there is a potential or there is a growth they can address out of this particular investment. Now, it basically works in the following manner, that it can be lending under general or specific agreement. That means you wanted to do a specific work within your organization, or you wanted to start a particular project within your organization, and you basically create a project report and then you submit and you ask that what kind of a fund you are looking for and how much amount you are looking for, what is the rate of repayment of that particular fund, and what the benefit this particular investors are going to get. So, there can be a specific project against which you can raise the fund, or it might be a general in nature, because you just want to address the growth which you are already doing in regular basis, and accordingly you want to get some fund into this thing. And if you are looking for that kind of fund, then are you looking for equity or the debt, and what is the repayment policy, or what is the benefit you are going to give. Even many of the time it might so happen that when you are getting the equity, and you might not able to make a payment of a good dividend initially, but you enters into agreement wherein you specify that in later on you are going to issue the bonus here to this particular organization, so that when you will go for a IPO or you are going to go for secondary sell, at that particular point of time these organization can make the money out of by selling this particular equity. So, whatever the way, or even they can use a convertibles, which they can have an option to convert this particular debenture into the equity, and by this process they can make money also in future. Now, there can be a negotiated investment. Negotiated investment, again, wherein you basically mutually agreed upon the particular pattern of investment, and you also decide the terms and condition on which you are going to make this particular investment. Now, it can be through the issuing of the debenture bond, or it can be through the issue of qualified institutional buyer. Possibly I am going to discuss this particular issue in my subsequent lecture. So, there can be negotiated terms relating to the financing of the corporations, and there can be a specific gestation period before this particular fund can be withdrawn by this particular public financial institution, or there can be a process which is defined how they can dilute this particular fund. Now, they can also respond to the book running or for the investment, and this book running may be for equity, debt, or convertibles. And book running means wherein you wanted to issue the shares either through private placement or a public primary market, and there you want this particular financial institution to come in board and they make an investment into your equity. So, in those particular circumstances, you basically respond to this particular investment, and you generally decide that how much premium you are going to pay for this particular investment, and then also you understand that there will be a potential growth of this particular industry. So, you can dilute your fund in future when it will be listed for trading into the secondary market. Now, you can also go for acquisition through the secondary market, and in many of the time you will find this particular public financial institutions are generally going to the secondary market to making an investment into the company shares. And these particular and if you look into the portfolio of any companies which are listed, you will find the majority of chunk of the shares are held by either DII or FII. DII means domestic institutional investors, and FII means foreign institutional investors, and they are basically all the financial institutions. So, they basically make an portfolio investment, and then they try to get the return either through the market capitalizations or through the dividend payment of the dividend, or for waiting for longer investment, so that they can be allotted with the bonus share, or there can be split in shares, so that they can make money out of this particular process. So, this is the way generally the public financial institution make an investment in the startup, but please do remember they generally do not make an investment in the beginning of the startup. It is basically in much later part of this particular the startup, or when the startup are in the growth part, they make an investment into this.